We're going to calculate the stock price for Keysight Technologies. And first we need the market cap, which is 19.76 billion. And then the stock price of 105.85. And now we know the shares outstanding because it's the market cap divided by the stock price. That's the shares outstanding. And we're going to calculate the future free cash flow of the company and discount that value back to today's dollars. That's the best way to value a company, is to calculate the future free cash flows. And when we get the value of the company, we just divide that by the shares outstanding to get a stock price and see how it compares to the actual stock price. So let's see the actual free cash flow. We'll go to the financial section in Yahoo, go to the cash flow section, and then copy last 4 years of free cash flow. And then we go to the income statement and go to the net income and pull the net income. And that's the profit loss. And then last is revenue. That's also on the income statement. And it looks like everything has been moving in the right direction. So it looks pretty good so far. Now we need to look at the capital structure of this company and figure out the discount rate we need to apply to the future cash flows. So the interest expense is the interest they pay on the debt. That's on the income statement. That's $80 million. And now we need to look at a balance sheet to see how much debt they have. No current debt, long-term debt of 1.8 billion. So that's debt due beyond 1 year. They pay 4.47% interest on their debt. Interest payments are tax deductible, so let's get their effective tax rate. So the income before tax, and this is on the income statement, and the income tax is 94 million. So they pay only 13% of taxes, so their cost of debt is 3.89%. And the weight of debt in the capital structure is 8%. That's a pretty good number. The lower the better, but 8% is a good number. So now we need to figure out the cost of equity. So we need the beta, that's 1.09. And beta is volatility, so stock isn't too volatile. And the cost of equity, we use a CAPM model to figure that out, and that's 10.7%, and cost of debt is 3.9%. So equity has a higher return than debt because equity is riskier. In the event of a default, debt holders are paid before equity holders. So the WACC is the weighted average cost of capital. That's a blend of the equity and debt. And that's 10.13%, and that's what we're going to discount the future cash flows by. So we calculated future cash flows for 4 years and then did a terminal value for all years after year 4. We discounted those numbers back to today, and we get a value of $11.4 billion. And when you divide that by 187 million shares, you get a stock price of $61, even though it's trading at 106. So we consider this a sell. It's trading at a 73% premium. And it looks like maybe a year ago it was trading in 60s. But now it's been trading at a premium. So stocks can trade higher or lower than intrinsic value. The stock price is based off of market demand. So if more people want to buy a stock, the price gets bid up. And if more people want to sell a stock, the price gets pushed down. And it's all how people feel about the expectations of the company in the future, whether they want to buy or sell the stock. So everybody has their own opinion on the value of a stock. This is my model. It's my opinion. So thanks for watching.